There are YouTubers in the finance space that are straight out scam artists, right? They simply just try to get your money. They give very, very bad advice. But then there are also the well-intentioned finance YouTubers. Now, even though following the advice by the right tutor might make sense, very often the content is dumbed down to a degree that in the end the fundamentals don't get properly understood. And I think the following video is an example of that. This short by Mark Tilbury is problematic because it dumps down things that much that then the viewer that watches this questions everything that's being said. We're going to watch the short. We're also going to look at the comments that are justified. So let's have a look.
If you spend $5 on your morning coffee on the way to work, $15 on a nice lunch from the food truck, $4 on overpriced transport, $2 on a sweet treat, and $1.40 on unwanted subscriptions, then that's the same as spending $10,000 every single year. Instead, you could brew your coffee at home for 50 cents, travel more economically for half the price, make a packed lunch for $4.50, go without the sweet treat, and cancel your unwanted subscriptions, which will save you $7,810 every year. Then if you invest that money in a low-cost index fund with an average return of 8% per year, in 30 years, you'd have over $1 million.
Now, the overall message is clear, right? Try to be as frugal as possible, invest this long-term into, say, index funds, and then in the end, when you're 60, you can retire with a nice nest egg. It's very nicely shown in this short, but things are only partially true. Why do we want all that money, right? Why do we want to be a millionaire? It's, of course, in order to spend a lot. So we want to have the spending power. We don't just want to have all the money laying around and then die with us. What really matters for long-term wealth is simply the delta between spending and income. And I always try to just increase my income because in theory, there is no ceiling for the income. There is a ceiling though for how much we can save, and life becomes miserable as we save more and more and more, right? It's way easier to work 1 or 2 hours more on a side hustle and do the spending than not doing the spending and working less. But that's actually not the main critique I have for this video. It's not even the things that I mentioned in the comments. Let's have a look at those comments. So check this out. This got 10,000 comments. $4 on any transport sounds like a steal. That's of course besides the point of this video. But interestingly enough, it did get most likes. Another comment on the taxi. Then the third comment has a bit more substance. Most young people these days aren't struggling financially because of overindulgence. They're struggling because their salary is barely enough to pay rent for a 1-bedroom apartment. This is very, very true. I made an analysis on this in prior videos. When we look at different income brackets, the incomes over time, of course, go up with inflation, but actually the money supply, right? USM2 grows even faster than any salary bucket. So the money supply grows on average by 6.8%. Salaries grow at different rates depending on how much you're earning. If you earn only in the lowest quartile, it grows only by around 4%. If you are in the highest quartile, it grows around 5%. Still, all salaries tend to grow not as quickly as the money expands. But again, I'm all for overindulgence in buying things that we like. We simply just have to work harder, right? We have to use our free time not to watch Netflix, but to potentially learn more, improve our skills, and at the beginning, sell more time. And once we've done that, we've got some kind of capital, maybe 1 or 2 years worth of income. Then we start leveraging this by improving the return on that capital. Now, here's another very important comment, and I'll talk about this in a second. Sad thing is, $1 million is barely an extraordinary amount today, let alone in 30 years' time. And this is so incredibly true. $1 million in 30 years' time is very, very little. And the question really is, if we just buy the S&P 500, right, and we buy this over 30 years, then really how much more purchasing power do we get? So I've already talked about this, right? This is USM2. This is the money supply in the US, and it grows at a constant rate. So this is a logarithmic chart. This here is the same thing on a linear scale. And as said, the growth rate of this line is roughly 6.8% per annum. So when the official inflation numbers say that the product only increased, say, by 3% per annum, I think that's misleading because, of course, over time, it's easier and easier to produce product, right? Technology progresses. And so making the bread today is much easier than baking the bread, say, 100 years ago. Now we've got all the machinery, etc. And so naturally, if there was no money expansion, right? If the money stock would be static, then the bread should get cheaper and cheaper every year. This is, of course, not what's happening. There is the 6.8% monetary supply. There is the official reported inflation rate of, say, 3%. The other 3 to 4% is simply just technological progress. So technological progress was able to make up for some of that monetary expansion effect. But again, let's go back to that million. Let's have a look at the S&P 500 relative to the US money supply over the very, very long term. So let's zoom out. Let's take the weekly chart. Let's go all the way back. And this chart starts now in 1960. So this is 65 years of data, longer than any of our careers will last. The S&P 500 outperformed monetary expansion by only 50% during all of those years. Less than 1 percentage point after monetary expansion per year. The question is really how sustainable is even that 1% since there's all this fluctuation. Now there are some effects that skew this a bit because we can't just buy the S&P 500. We have to buy an ETF on the S&P 500 and that comes with some management fee. It can be very small, right? It can be 0.2, 0.3%. We've got a very, very cheap ETF, but still there are some fees. On top of that, we've also got taxes, right? If we buy now and we sell later and we don't do this smartly in a retirement account, for example, then you have to pay taxes on the capital gains if you trade too often. But then as a counter argument, we also have dividends, and the dividends, they make up for the taxes potentially or for the fees. And so really it depends on how smartly you have set this up. If you pay the taxes, if you pay the management fees, if you are very smart about this, you might get a bit more than 50% over the course of 65 years. But still, it's not really that impressive. And let's say this is simply just fluctuating around some kind of base level and there's actually really no long-term price expansion relative to USM2. I think this is a pretty realistic scenario actually, because the long-term price to earnings ratio is at historical highs. What that then means is that we really don't get any purchasing power gain by buying the S&P 500 long-term. Yes, we probably can buy more bread, say, in 30 years, but we're not able to buy, say, more property or more education or more medical expenses at the time, because those kind of things, they go up higher than just those 3% per annum. And so just for the sake of it, right, let's say we have this $1 million. How much will it be worth 30 years from now? Let's take just the product inflation rate. So you're really just spending this on super basic consumer goods, not on anything fancy. Let's say you don't need the doctor's appointment, etc. In that case, we can maybe work with just 3% inflation rate. In that case, $1 million will be worth 30 years from now the same as 400K today. Now, instead of taking the 3%, let's now take the 6.8%. What I believe is really the inflation rate. This is how quickly money expands. So let's take this formula over here. That's what we get, 120K. Now, 120K is not nothing, but 120K after 30 years, right? During an entire career is not really that much if you all the time didn't go out eating, if you didn't take the taxi, if you made all of those sacrifices in lifestyle. I don't think 120K in purchasing power is really worth it. Now, in general, the message of this short is okay, as in it does make sense to invest, because at least the S&P 500 can withstand the money expansion, right? It's better than just keeping the money on the sidelines. But I'm not really sure if saving is the right approach. It's better to work hard on getting the income up, to climb up the career, to switch jobs, to have side hustles, to just make more money, to become better and better every year at producing more and more money. And that income increase should outpace 6.8% per annum. If you can increase your income by 10% every year, you're probably much better off than saving on that coffee or saving on the sandwich that you buy during lunch break. It's really an income game. It's not a savings game. And when we then invest, we have to be smart about this as well, right? We have to diversify, and we should buy, besides just the S&P 500, something that has the potential to also return more. For example, Bitcoin, right? Bitcoin right now is very expensive, but let's say Bitcoin now crashes at some point again in the future by 50, 60, 70%. probably taking then the additional savings not in the S&P 500 but partially into Bitcoin does make sense. Bitcoin is not going to go away in 20 years, I believe. The reason why the S&P 500 return is the way it is not just because companies get more and more efficient. It's also because there's more and more adoption of stocks. More people own stocks today than 50 years ago. And that, of course, will also push up relative PE ratios, right? Because more people simply just buy stocks. And now I know this video isn't as flashy as Mark Tilbury's video, and probably not everybody will watch this until the end, but the people that do enough to then in the end become a winner in the system.
Now here's the thing, there are plenty of topics within crypto that aren't very sexy, but that are, I believe, very vital to make money long term. For example, concepts like correlation. What we see over here are correlation coefficients. Did you know, for example, that most altcoins tend to be more correlated with Ethereum than with Bitcoin? In other words, it's not when Bitcoin goes up that the altcoins go up as well. It's rather when Ethereum goes up, then the altcoins go up as well. Or did you know that the correlation coefficient of the S&P 500 to Ethereum, and thus the altcoin market, is actually quite volatile? In other words, it does make sense to also own stocks, not just Ethereum, not just crypto. The common narrative is that when traditional markets go down, that crypto tends to go down as well, right? That crypto is simply just a levered bet on, say, technology stocks. That's not the case. The correlation coefficient is relatively close to zero. Or do you know the long-term expected returns of various asset classes, of, say, gold, of, say, the S&P 500, of Bitcoin, of altcoins? When we don't just own crypto, but we also own property, for example, and we've got that portfolio, what kind of returns do we need in order to beat monetary debasement, but also in order to, at some point, to get financially free? How much money do we need to have enough passive income to not having to work anymore? What are expected long-term returns, and how much should we actually allocate towards crypto and towards property, towards stocks, gold, bond, etc.? What actually makes sense? When there are tens of thousands, hundreds of thousands, maybe even millions of dollars on the line, not having this properly nailed down is a huge problem. And when the market isn't that great anymore and the upside for Bitcoin could be somewhat limited, how can we still make money? How can we make money from charts like this? What we see over here is Balancer relative to Ethereum. We can make money by shorting this. Balancer has very bad tokenomics, the supply increases over time, and so it tends to do worse than Bitcoin and Ethereum over the long term. And we can make money from that, again, from the relative valuations, not just from US dollar valuations. When we look at how quickly is the monetary base expanding, and we put this into relationship to how quickly are salaries increasing, we actually see that pretty much everybody is falling behind over time. And this is not just true for the poor people, this is even true for the top 5% of earners. By the way, if you earn $500,000 per year, then you are in the top 5%. But yeah, data like this is useful. And those are not necessarily the sexy topics that work well on YouTube, right? On YouTube, it's the 100x altcoin gems that get all the clicks. But when you talk about diversification and correlation, etc., people just fall asleep. But it's the long-term planning, the long-term proper allocation towards different asset classes that actually make the difference. And so have a look at all of this. Those are tutorial videos of the premium membership of this channel. It's down below, thebitcointrader.com. There's more than 100 tutorial videos in total. What are my favorite crypto macro indicators? How do interest rates impact different asset classes? We've just seen how the market got spooked because the Federal Reserve might get more hawkish. Or how do we adjust our returns for risk mathematically, right? Everybody can get more returns by increasing the risk massively, but the idea is we want to get the best returns for the risk. And so there are ways to calculate this using alpha and beta. Those are all very complex topics, but I strongly believe that it's the skilled people, the people that have most knowledge, that tend to make most money over time. Now, besides all of those tutorial videos, there are also various chats in premium where I try to be active as well. So in case you've got any questions, just tag me in a message in those premium chats and I try to reply. The membership is currently $165 per month. This is not for people that only have a net worth of $1,000, right? This is for people that actually have to manage wealth in the tens of thousands, preferably even hundreds of thousands of dollars. There is a 1-week money back guarantee as well. So in case you don't like premium, just message me within the first week and I refund you 100%. There's really zero risk for you. Now, if it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you in the next video or see you in premium. Cheers.